Hello, everyone. This is Sebastian McMahon from IA Financial Group. And as you can see, we're changing the format this week. So I will be now doing an overview of the themes of the week without any charts. And then we'll dig into the charts later on in this presentation. So another innovation this week that I want to communicate, I created a Twitter account. So if it's something that you like to go to on social media to have some news, well, you can search for my name, Sebastien McMahon, or I'll give the identifier later in this presentation. I also share content on LinkedIn almost daily. So if you haven't done so already, you can follow me on LinkedIn. It will be my pleasure to keep you informed that way. So this week, the week ending October 29th, was marked by the Bank of Canada's decision. So we are hinting at rate hikes in 2022. So that moved the interest rates higher on the short part of the curve. TSX was lower. The US stock market was higher on the week. And if start to look at next week already, well, next week is a big one. We'll have the jobs reports on both sides of the border. Remember that Canada's job market is way stronger than the one in the US. We'll also have the ISM services, the ISM manufacturing index, and we'll have the Fed decision also coming on Wednesday. So that's the overview. So now let's dive into the charts. All right, so one of the highlights of the week was US GDP coming out for Q3. The US is the first one to publish its Q3 estimates. So we had growth of 2% quarter over quarter annualized. This is looking very much like what we should have in Canada, because in Canada we had the figures for August. So we're still missing the month of September, which will be published in 1 month, but we're also looking for somewhere around 2%. So the growth picture right now, if you look at real GDP, well, the US is outperforming Canada and Europe, so it seems to have an advantage. That's why the blue line that you see here is above the other ones, and it's a bit longer because we have Q3 in the US and not elsewhere. But we will argue very strongly that looking at the labor market might be more important than looking at GDP right now. And in Canada, we regained 100% of the lost jobs. In the US, it's only 80%. So we do still see an advantage for Canada. Talking about Canada, the Bank of Canada rate decision this week. Goodbye QE. So quantitative easing is done. Now is the reinvestment phase that's in there. And I strongly encourage you, if you haven't done so already, to go look at the Economics and Finance 101 section on the webpage. You'll find a video on central banks and monetary policy that will explain all of that. So just to make sure that everyone understands correctly what's going on. But their bank is hinting at rate hikes next year, a bit earlier than what was expected before. They're talking about the middle of the year instead of late in the year. So that pushed expectations for a rate hike higher, and that pushed expectations for, well, that pushed the 2-year rate in Canada much higher. So let's first look at the expectations for rate hikes. So this is what's implied in the market by the interest rates that we see right now. So what's implied is that we'll have 5 rate hikes by the Bank of Canada by July, which is way too much. I'm pretty sure we will have at least 1, probably 2, not very likely 3, but 5 until July. So the gray line is the number of rate hikes expected by July of 2022. This is way too high. So we don't really agree with the views of the markets here. And financial markets, the big theme of the week was exactly this. So the massive rise in the 2-year rate. So it looks like the Tesla stock price, or maybe a meme stock or something like that. So pushing like exponentially higher on the 2-year rate. So what does that mean for you? Well, makes us even more bullish on the Canadian dollar. So here you have 2 charts. On both charts, the gray line is the Canadian dollar. On the left chart, you have the blue line, which is the 2-year rates differential. So it's the 2-year rate in Canada minus the 2-year rate of the US. As you can see, pretty much at for the last 15 years, except for the last year or so, has been this rate differential has been tracking the Canadian dollar very well. Now it's pointing towards 95 cents on the Canadian dollar. And if you don't like that, you can go to the right-hand chart. Now it's the oil price, and the price of oil at 84 bucks on the barrel for the Brent. It's pointing towards 90 cents on the dollar too. So we think there's no reason for the CAD to be trading at 80, 81 cents. We do see a fair value of around 90 cents. So how long will it take to get there? We don't know, but we are positioning for it. So in all of the managed solutions that we manage, the diversified funds, selection funds, even in diploma elementary, you'll find a good chunk of hedging there. We think the Canadian dollar going higher means that we need to protect the exposure on foreign assets. So we're hedging the portfolio there, very bullish on the CAD. So that wraps it up for the week. ia.ca/economy is your go-to webpage. Economy and Finance 101. If you haven't seen it yet, I strongly encourage that you take a peek. We will be adding more videos through time. There's 3 already, but as your suggestions come in, we'll address them, and we want to regularly add some stuff. And on the right, Twitter at SebMcMahon_IA, or on LinkedIn if you don't follow me already, just send me an invitation. I'll be very happy to be your LinkedIn contact going forward. So that's it for this week. See you again next week.